Good morning and wishing you a wonderful Wednesday. Welcome to today's episode of Morning Wealth. We're talking about three things today: US manufacturing data, oil at a 2-year high, and earnings from Zoom. Major US indexes finished Tuesday's session roughly flat after fresh data showed that US manufacturing activity, while expanding, continues to be affected by rising commodity prices, material shortages, and difficulties in the labor market. Stocks climbed after the opening bell to kick off the month of June, but later pulled back and gave up their early gains. The S&P 500 ultimately lost 0.1%. The Nasdaq also was down about 0.1%. The Dow, on the other hand, was up 0.1%. Investors had been growing more confident recently that rising inflation won't lead central banks to unwinding stimulus measures, pushing major indexes back towards all-time highs after shuttering in early May. The S&P 500 on Friday finished the month of May by notching a fourth consecutive month of gains. In the bond market, the yield on the 10-year Treasury edged up as well to about 1.61 from 1.59. In overseas market, the Euro Stoxx 600 rose about 0.7% to a new record close. The Shanghai Composite rose about 0.3% and the Japanese Nikkei was down by about 0.2%. On to the data that came out yesterday on manufacturing. The Institute of Supply Management on Tuesday said its index for manufacturing activity rose to 61.2 last month from April's already high of 60.7. Remember, anything above 50 indicates manufacturing expansion. The reading is a reflection of the unusually strong demand for goods that the pandemic set off. Unable to spend their money on services like travel and restaurant meals, and in many cases laden with extra cash as a result of the government relief payments, Americans have been buying things instead. But with COVID-19 cases falling and the shares of vaccinated Americans continuing to rise, it's difficult to say how long the party will last. So on the one hand, as the economy reopens, it seems likely consumers will direct more of their money towards services, and that shift could be oversized as people make up for lost time. Families might extend their vacations, for example, or make what used to be one restaurant meal a week into two. A lot of the demand for goods might have been pulled forward as well. The big screen television bought to while away the pandemic isn't going to be bought again. But despite that possibility, demand for goods in many cases is still overwhelming supply, while the global computer chip shortage and the other supply chain bottlenecks have made it even harder for manufacturers to produce enough. So if you look at the sub-indexes, the index of manufacturers' orders backlog within the Tuesday's report reached its highest level since the ISM began reporting in 1993. And the ISM's index for supplier deliveries, which goes higher when delivery times are slower, hits the highest level since 1974. Though the top line number rose, and it's a good sign, the underlying indexes, sub-indexes as we call it, on the order backlog and also the delivery times show that there is still strain in the manufacturing supply chain. On to oil now. The global oil price benchmark closed above $70 a barrel for the first time in 2 years on investors' optimism that improving demand and a dwindling supply glut may mean that the market can absorb any additional production from OPEC and its allies. Brent crude rose about 1.3% to about 70.25 a barrel, the highest close since May 2019. The WTI also was up about 2.1% to 67.72 a barrel. The US gauge settled at its highest level since October 2018, in fact. Members of the Organization of Petroleum Exporting Countries and their allies, known as the OPEC Plus, on Tuesday agreed to continue relaxing curbs on oil production, signaling their confidence in improving oil demand and a drop in the global supply glut. Prices began rallying after a technical committee within the cartel on Monday confirmed forecasts for a rebound of about 6 million barrels a day in world oil demand this year. Lastly, wanted to cover earnings from Zoom. Zoom Video Communications was trading slightly higher in late trading Tuesday on better than expected results for its fiscal first quarter ended April 30th. Shares of Zoom was up about 1.5%. The stock, though, is down about 43% from its pandemic era peak at nearly 589, which it hit in October. Zoom has consistently produced huge forecast beating quarters throughout the pandemic, and it did it again this time, though this report marks the video conference company's first quarter of slowing sequential growth in a year. So for the quarter, Zoom posted a revenue of about 956.2 million, up 191% from a year ago, and ahead of both the company's guidance range of about 900 million to 905 million and the street consensus estimate of about 906 million. Note that the growth in each of the last 3 quarters was above 355% for this company. So growth of nearly 200% represents a considerable slowdown. For the January 2022 fiscal year, Zoom lifted its revenue guidance to a range of about 3.97 billion to 3.99 billion from a previous forecast range of about 3.76 billion to about 3.78 billion. So the guidance is also up. Zoom also said it has about 497,000 customers with more than 10 employees, up about 87% from a year ago. The company has said that about 1,999 customers generated more than 100,000 in trailing 12 months revenues, up about 160% from a year ago. Comments from the CEO: we kicked off the fiscal year with a very strong first quarter. Our steadfast commitment to empowering customers to work and learn from anywhere with our expansive, innovative and frictionless video communications platform continued to drive our results. That is the update. Stay safe and healthy, and I'll speak to you tomorrow.